In March 2020, the world's safest financial asset did something it's not supposed to do. US Treasury bonds, the thing you buy when everything else is falling apart, started falling apart too. Stocks were crashing, credit markets were seizing, and investors were selling treasuries not because they'd lost faith in the US government, but because they needed cash so badly they were liquidating the one thing everyone agrees has value. The safest asset in the global financial system became the accelerant. And the uncomfortable part? It wasn't a fluke. It was a design consequence. Here's the mechanism most people miss. Safety in financial markets isn't just a quality, it's a resource. And when too many strategies depend on the same resource, that resource becomes a single point of failure. The more the system relies on safe assets to function, the more violently things break when those assets stop behaving safely, even temporarily. To understand how this works, you need to see treasuries the way the financial system actually uses them, not the way most people think about them. The common understanding is simple. Treasuries are boring, reliable, low-return investments. You park money there when you want to sleep at night, but that's the retail view. At the institutional level, treasuries aren't just investments, they're infrastructure. They're the collateral that secures overnight lending between banks. They're the margin backing trillions of dollars in derivative contracts. They're the reference rate that prices nearly every other asset on the planet. Nearly $30 trillion in marketable US government debt is currently outstanding, and a staggering share of it is pledged, leveraged, or repoed at any given moment. This is where the architecture gets interesting. Because treasuries are considered virtually risk-free, the system allows them to be used with minimal capital buffers. A hedge fund can buy $1 billion in treasuries and finance 95% of that purchase through overnight borrowing, using the treasuries themselves as collateral. The logic is circular, but under normal conditions, it holds. The collateral is safe, so you don't need much of a cushion, so you can borrow more, so you can hold more of the safe thing. It's an exploit loop, a self-reinforcing cycle where the output feeds back into the input, and the system allows it because at no individual step does anything look broken. This is the foundation of something called the basis trade. A hedge fund buys treasury bonds in the cash market and simultaneously sells treasury futures contracts, capturing the tiny price gap between the two. The spread is minuscule, fractions of a percent. But when you lever that position 10, 15, sometimes 20 times over using cheap overnight repo financing, those fractions compound into real returns. By late 2024, Cayman-domiciled hedge funds alone held an estimated $1.85 trillion in treasury positions, much of it tied to this strategy. The total notional exposure of basis trades was somewhere between $1 and $2 trillion. Now pause on that for a second. The trade itself isn't speculative in the traditional sense. It's an arbitrage. It profits from a mechanical price convergence that almost always happens. Under normal conditions, it actually improves market liquidity. Hedge funds provide a service by absorbing treasury supply that might otherwise overwhelm dealers. The problem isn't the trade. The problem is what happens when the conditions stop being normal. In March 2020, the pandemic shock triggered the opposite of what textbooks predict. Instead of a flight to safety, everyone buying treasuries and driving prices up, the market experienced a dash for cash. Mutual funds needed liquidity to meet redemptions. Foreign central banks needed dollars. Hedge funds faced margin calls as volatility spiked, and the fastest way to raise cash was to sell whatever was most liquid, which meant selling treasuries. The very quality that made treasuries useful as a financial tool, their deep liquidity, made them the first thing to get dumped when everyone needed money at the same time. Hedge funds running basis trades sold an estimated $173 billion in treasuries in a matter of weeks. Dealer balance sheets, constrained by post-2008 capital rules, couldn't absorb the volume. Bid-ask spreads blew out, prices dropped, and because treasuries are collateral for everything else, falling treasury prices triggered margin calls on other positions, which triggered more selling, which pushed prices down further. The Federal Reserve stopped the spiral by buying $360 billion in treasuries in a single week, more than 4 times what it purchased monthly during its most aggressive round of quantitative easing. The system didn't self-correct, it was rescued. Now, that was one version of the safe asset trap. Here's another. In 2022, a budget announcement by the UK government sent gilt yields spiking more than 100 basis points in 4 days. That's an extraordinary move for a sovereign bond market. But the real story wasn't the budget. The real story was what was sitting underneath it. UK pension funds had adopted a strategy called liability-driven investment, LDI. The idea was straightforward: match the duration of your long-term pension obligations by holding long-dated government bonds. Sensible in theory. But because holding enough bonds outright to match liabilities was expensive, pension funds used leverage. They'd buy gilts, pledge them as collateral through repo agreements, use the borrowed cash to buy more gilts, and repeat. Some funds were leveraged 3 or 4 times over. When gilt prices dropped, these funds faced collateral calls. To meet them, they sold the most liquid thing they had, more gilts, which pushed prices down further, which triggered more calls. LDI funds dumped roughly £25 billion in gilts in 5 weeks, with nearly a third of that selling concentrated in the first 5 days. The Bank of England intervened with emergency gilt purchases to stop what it called a threat to UK financial stability. A leveraged bet on the safest asset in the British financial system nearly cratered that system. And then there's the version that actually did take down a bank. Silicon Valley Bank loaded its balance sheet with long-duration Treasury and mortgage-backed securities during the pandemic, when deposits were flooding in and rates were near zero. By the end of 2022, the bank was sitting on $15 billion in unrealized losses on its held-to-maturity portfolio, enough to wipe out its entire equity base. When depositors started pulling funds, SVB had to sell $21 billion in bonds, crystallizing $1.8 billion in losses. The announcement triggered a run. Within 44 hours, the bank was gone. Across the US banking system, unrealized bond losses totaled $620 billion at the end of that year. These aren't 3 separate stories. They're the same story told 3 different ways. The mechanism is identical each time. A safe asset gets used as the foundation for leveraged positions. The leverage works beautifully in calm markets because the asset is stable. But when the asset moves, even a little, even temporarily, the leverage amplifies the move, forces selling of the safe asset itself, and creates a feedback loop that turns a small disruption into a systemic event. It's a trap built into the architecture. And the trap gets deeper over time because the global financial system keeps needing more safe assets. Central banks need them for reserves. Banks need them for regulatory capital. Pension funds need them for liability matching. Clearinghouses need them for margin. Money market funds need them for yield. The entire meta has warped around a single dominant strategy. And when every player is running the same build, a hard counter doesn't just beat one of them. It beats all of them at once. All of that demand encourages the exact behavior that makes the system fragile. More leverage against the same collateral base. More strategies that assume the safe thing stays safe. More interconnection that ensures when it doesn't, the damage is everywhere at once. The Office of Financial Research published a model that captures this precisely. In their framework, safe asset markets contain 2 types of holders: investors who hold treasuries because they're safe, and investors who hold treasuries because they're liquid, meaning they plan to sell them when they need cash. Under normal stress, these 2 groups offset each other. Safety buyers come in when prices dip, absorbing what liquidity sellers dump. But when stress is severe enough, or happens fast enough, liquidity sellers look ahead and realize that future prices might be even worse. So they sell preemptively. That preemptive selling overwhelms the safety buyers, and the whole dynamic flips. Flight to safety and dash for cash happen simultaneously, feeding off each other instead of canceling out. The authors compare it to a bank run, except it's happening inside the market for government bonds. The system has tried to learn from this. The Federal Reserve created a standing repo facility so that dealers can always swap treasuries for cash at a set rate. Margin requirements on basis trades have been tightened. The SEC is mandating more central clearing of Treasury transactions, with implementation dates stretching into 2026. And after the LDI crisis, UK pension regulators now require funds to maintain yield buffers of at least 250 basis points before leverage kicks in. These are real improvements, but they're patches on an architectural feature, not a fix. As long as one class of assets serves simultaneously as investment, collateral, and liquidity reserve for most of the global financial system, the concentration risk is structural. The safer the asset appears, the more it gets used. The more it gets used, the more leverage builds around it. And the more leverage builds, the less safe it actually is when it matters most. If this kind of systems-level breakdown is what you come here for, understanding not just what happened, but the architecture underneath it, subscribe to 8-Bit Economics. Every week, we strip complex financial mechanics down to their core logic. No hype, no predictions, just the underlying code that most people never see. Hit subscribe, drop a like if this shifted how you think about safe assets, and tell me in the comments. What other safe assumptions do you think are hiding leverage underneath? By the time everyone sees it coming, the smart play is already over. Here's the part that should stick with you. The phrase safe asset implies a fixed property, as if safety is baked into the bond itself. But safety in a financial system isn't a property. It's a relationship between the asset and the architecture around it. When the architecture leans too hard on that safety, it hollows out the very thing it depends on. Not because the asset fails, but because the system's reliance on it creates the conditions for failure. Treasuries didn't stop being safe in March 2020. The system just finally revealed what happens when everything that's supposed to work assumes the same thing at the same time. The safest asset in the world is only as safe as the structure built on top of it. And right now, that structure is very, very tall.